You got an idea that could change your life. You've spent nights sketching business models, your best friends ready to invest, and you can already imagine your logo on a glass office door. But what if I told you that even if you do all of this, your company might not legally exist? Yes, you could sign contracts, make deals, even get investors, and still, in the eyes of the law, your business might be nothing. That's exactly why we're starting our ACCA corporate and business law journey with the first and most powerful topic, company formation and capital. Because this is where every company, and every ACCA student's understanding of law, is either built or broken. Now, imagine this. You're sitting in your ACCA exam, and the question says, explain the principle of separate legal personality using relevant case law. You look at it and smile, because you've heard the story of a man named Salomon. But most students don't know that this one story can make or break your law paper. So let's talk about him. Salomon was a hard-working leather boot manufacturer in 19th century London. He'd been running his business as a sole trader, like many of his start, small, personal, and hopeful. Then the law changed, and it became possible for individuals to incorporate their business into a limited company. Salomon decided to do just that. He registered his company, Salomon & Co. Limited, with himself, his wife, and his 5 children as shareholders. Everything was perfectly legal. But here's where things went wrong. The company later collapsed into insolvency. Creditors demanded their money and said, "This isn't a real company, it's just Mr. Salomon hiding behind a name. He should personally pay the debts." They accused him of abusing the company structure. And when the case went to court, it became a battle that defined business law forever. In 1897, the House of Lords gave their judgment. They said, the company is a separate legal person. It has its own identity, its own liabilities, and its own existence, independent of the people behind it. That single sentence changed everything. It meant that once a company is incorporated, it's treated by the law as a new person. It can sue, be sued, own property, and make contracts, all in its own name. This principle is called the doctrine of separate legal personality, and it's the bedrock of corporate law. In your exam, the moment you write according to Salomon versus Salomon & Co. Limited, 1897, the examiner immediately knows you understand this foundation. Now, let's bring that idea into real life. Picture Sarah, one of my students who started a small baking business called Sweet Spoon. She opened a shop, printed her brand name, started selling cakes, and everything was going well. But when a supplier failed to deliver ingredients on time, she wanted to take legal action, only to find out that her business wasn't incorporated. Legally, it wasn't recognized as a company. That means she, personally, had to bear all liabilities. Her business was just her, not a separate entity. That's why incorporation is not just paperwork. It's your business's birth certificate. And that certificate of incorporation, issued by Companies House, is the exact moment your company becomes a separate person in the eyes of the law. Here's where 90% of ACCA students go wrong. They think company formation happens when you open a business bank account or start trading. Wrong. The moment of formation is when Companies House issues your certificate of incorporation under the UK Companies Act 2006. From that point onward, your company exists. Now, let's understand how that formation actually happens, because the exam will expect you to explain it clearly. To form a company, you must submit key documents, the Memorandum of Association, the Articles of Association, and a completed application for registration. Once Companies House approves these, it issues the Certificate of Incorporation. The Memorandum of Association confirms that the subscribers, the first shareholders, wish to form a company and agree to become members. The Articles of Association set out the internal rules, how the company will be run, the rights of shareholders, how directors are appointed, and so on. Once the certificate is granted, the company becomes a legal person, capable of owning property, hiring employees, and signing contracts. You could literally not exist tomorrow, and why? Company would still continue existing. Let's make it relatable again. Imagine you're revising at 2 a.m. the night before your ACCA exam. You're tired, frustrated, and you read the question, explain the significance of the Certificate of Incorporation. Just remember this, that document is the moment a business becomes alive in the eyes of the law. It's the line between being you and being your company. Now that we know how a company is formed, let's move to what gives it life, capital. Capital isn't just money. It's the financial backbone of a company, the proof that it's serious, stable, and trustworthy. In ACCA terms, we talk about share capital, authorized capital, issued capital, and paid-up capital. Let's break these down like a smart student would in the exam. Share capital is the total value of shares issued by the company. If a company issues 1,000 shares at £1 each, that's £1,000 share capital. Simple. Authorized capital, now often called nominal capital, is the maximum amount of share capital the company is allowed to issue. According to its constitution, issued capital is the portion actually given to shareholders, and paid-up capital is how much shareholders have actually paid. For example, if they've only paid 50p per share, that's £500 paid-up capital. But here comes the golden rule: once that money is invested, it belongs to the company, not to the shareholders. The company might go bankrupt tomorrow, but shareholders can't demand that money back. This is called the maintenance of capital principle, another core area of your exam. Why does this principle exist? Because share capital isn't just company money, it's the creditor's protection. It ensures that the company keeps a minimum fund for paying debts. The law doesn't want directors to treat share capital like their personal wallet. This rule was cemented in the case of Trevor v. Whitworth, 1887. The company in that case tried to buy back its own shares, basically returning capital to shareholders. The court said, you can't do that. Why? Because allowing that would drain the funds creditors rely on. So, if the exam asks, why can't companies simply buy back their own shares or return capital freely? You write, because of the maintenance of capital principle established in Trevor v. Whitworth, 1887, ensuring creditor protection. Now, let's make that practical again. One of my students, Adil, started a tech startup called ByteBolt Limited. He and his co-founder invested £10,000 each. A year later, the business started losing money. Adil said, let's withdraw our investment before it's too late. But legally, they couldn't. That £20,000 wasn't theirs anymore, it was the company's capital. It existed to protect creditors, not to be taken out casually. That's the moment Adil finally understood what separate legal personality really means. Speaking of separate personality, let's dive deeper. Once a company is incorporated, it's treated as a separate person. This also means limited liability. Limited liability protects shareholders from personal financial loss. In other words, you only lose what you've invested, nothing more. If your company fails owing £1 million, but you only invested £1,000, you lose just that £1,000. You don't sell your house or your car. That's the advantage that motivates entrepreneurs to form companies. However, this shield of limited liability isn't absolute. Courts can lift the corporate veil when the company is used for fraud, dishonesty, or evasion of law. Two classic cases that ACCA loves: Guilford Motor Company Limited v. Horn, 1933, and Jones v. Lipman, 1962. In both cases, individuals tried to misuse the company form to avoid personal obligations. The court saw through it and held them personally liable. This shows that incorporation is not a toy. It's a privilege the law can withdraw when misused. In recent times, cases like Uber BV vs. Aslam, 2021, have shown how modern corporate structures are constantly tested to balance limited liability with fairness and accountability. Now, let's zoom out for a second. How do companies get formed today, in 2025? It's not like the old days of printing forms and waiting weeks. Now, you can literally form a company online in under 30 minutes through Companies House. You fill out the details, upload your articles, pay a small fee, and receive your digital certificate of incorporation instantly. Done. You've just created a new legal person in half an hour. But here's the paradox that shocks most students: the legal foundation of that 30-minute process is still based on laws written more than a century ago. The same principles from Salomon, 1897. Even AI tools are starting to shape modern incorporation. Many entrepreneurs now use AI to draft their articles of association, define business objects, and even suggest share structures. Yet, the underlying principle remains unchanged. The company is a person in the eyes of the law. Now let's bring this closer to what you care about most, your ACCA exam. Examiners test this topic in very predictable but tricky ways. They want to see if you can apply law to facts, not just memorize. The best approach? The ISAC method: identify the issue, state the law, apply the law, conclude. Let's do a quick example together. Question: explain the principle of separate legal personality and its effect on shareholder liability. Your answer outline should be: issue: whether a company is a separate entity from its shareholders. Law: according to Salomon v. Salomon, 1897, a company, once incorporated, becomes a separate legal person. Application: therefore, shareholders are not personally liable for company debts beyond their investment. Conclusion: the company has its own legal identity and limited liability applies. That's how you secure marks quickly, structured, short, and clear. Because you're now learning with Education Bench, where we don't just teach you to study law, we teach you to think like a lawyer. So, if you want to pass your ACCA law paper confidently this December, subscribe, stay connected, and let's keep building your knowledge, one powerful concept at a time. Because success in ACCA isn't about memorizing rules, it's about understanding the logic behind them. And trust me, once you understand why the law works the way it does, your marks will follow naturally.